Today, I wanted to deep dive into a stock pricing and valuation metric. The most commonly used valuation metric in the stock market from an equity investor's perspective is the price to earnings ratio, which is generally noted as the PE ratio. Now, I've been monitoring a lot of videos on YouTube, and they spend 10 or 20 minutes talking about how PE ratio is important and that you need to focus on this valuation metric to succeed, and also the way to calculate the PE ratio, which literally takes like 2 seconds to learn it yourself. It really amuses me how all bullshit YouTubers talk about this simple metric on and on, wasting everyone's time, and what they're saying can actually be explained in 2 seconds. Today, I want to cover this concept of price to earnings, but going further from here, how to actually understand this number and how you should apply it yourself when you're investing. Okay, now, what is price to earnings ratio? It is a very simple concept. All you need to do is divide a company's market cap by its net income. Assuming that company A's market cap is currently at 100 billion and its net income is at 10 billion, the company's price to earnings ratio is 10x. Simple, right? Now, this is where all YouTubers stop explaining about the concept itself and just go on and on about the importance of this metric and how you should be looking at it all the time. Now, why don't we just deep dive into it? I want to break down this topic into 5 topics to help you get a better idea of what this metric actually means. Number 1, why is price to earnings ratio actually important? So price to earnings ratio shows how long of a time a company takes for it to make money up to the total value of the shares you paid to purchase for it. For example, in the example I gave you just now, company A's market cap was at around 100 billion and its net income was at 10 billion, implying a price to earnings ratio of 10 times. What this means is that starting from today, this company A will take 10 years for it to make the money you paid to purchase the company. So assuming you purchased 10 shares out of a million shares, total shares of the company A, it would mean that you're owning 0.001% of the company's stake. If you purchase those shares when the company was at a market cap of 100 billion, as a shareholder, you're also potentially gaining the right on 0.001% of the 10 billion net income the company is generating, which you can potentially benefit through dividends or share buybacks in the future. So basically, the basic concept is how long of a time it takes for you to get your invested money back from the company down the road. Depending on the price to earnings ratio, it may suggest that it may take 10 years or 5 years or 20 years. Now, based on what I told you now, low number looks good, right? Getting your money back in 5 years is definitely better than getting it back in 10 years. Well, that's not really the case. So let's move on to the next topic. Number 2, understanding price to earnings ratio from financial projections perspective. Now, we talked about the overall concept of price to earnings ratio. Right now, you might think that a 5 times price to earnings ratio company is better to invest than a 10 times price to earnings ratio company. Well, let's try to prove that that is not the case. Let's say that you have company A and company B. Company A and company B both currently have market cap of 10 billion, while company A has net income of 1 billion, while company B has net income of 500 million. This means that company A is trading at 10 times price to earnings ratio, while company B is trading at 20 times price to earnings ratio. Does company A look better to invest? Well, let's think about that. Let's assume that in 2024, company A and company B recorded net income of 1 billion and 500 million. But in 2025, company A again recorded 1 billion and company B suddenly also recorded 1 billion. Then in 2026, company A's net income still stays at 1 billion, but company B's net income increased to 2 billion. In the next 2 years as well, let's assume that company A's net income stays at 1 billion, but company B's net income increased to 3 billion and 4 billion. Now in aggregate, over the 5-year time frame, company A generated total net income of 5 billion, while company B generated total net income of 10.5 billion. While it might seem like you're investing in an overvalued stock at the time of the investment, looking at this result, investing in company B turned out to be a better choice. This is why a company's future prospect is much more important than its historical performance when you're investing in a stock. So let's move on to the next topic. Number 3, understanding price to earnings ratio from a regression analysis perspective is important. So based on what I told you so far, you'll now understand that low PE is not always a good thing. So now let's try to deep dive further into how we can understand the price earnings ratio better relative to its earnings growth. So now you understand that the future net income is crucial when buying a stock. So to get an even better idea of whether you're making the right purchase, you can do what is called a regression analysis. A regression analysis is something you do to find out how much of a close relationship two metrics would have with each other. Generally, the formula is a linear formula which is noted as y equals A plus XB. If you have a fair number of set of data, you can automatically generate the chart and the equation in the Excel. So this is the Excel spreadsheet. And here I have 10 companies with different price to earnings and next 5 years EPS growth. There are two things to consider here. When you're running this regression, number one, please make sure that you're comparing against the companies within the same industry. And number two, make sure that you have around 10 companies to make the regression analysis more meaningful. Now, I'm not going to go into the details of the formula, given the goal here is really to be practical rather than being academical. So with the data that you have, you can create a scatter chart in the Excel like this. And if you press the plus icon next to the chart, you can also add a trend line and a regression formula. Now, based on the trend line, you can get a sense of how steep of a relationship your set of data has with each other. Also, if you press the plus button again, you can also insert a thing called R squared. Now, what is R squared? R squared shows how much of a correlation the two sets of data you laid out have against with each other. A higher R squared means that the correlation between the PE ratio and the earnings growth are highly correlated. So you can confirm that for the industry which you picked, a higher earnings growth leads to a higher PE ratio. The reverse would work for the vice versa. Now, I would suggest that you only put a lot of confidence on your PE ratio and the correlation with its net income growth projections only if this R squared is above 0.8. R squared is between the range of 0 and 1, and a 0.8 would act as a strong basis for you to believe that the price to earnings ratio of the stock you picked is trading either high or low because of its earnings growth is either high or low. Number 4, always look at forward price to earnings ratio. Now, when I say forward price to earnings ratio, what I mean is a forward-looking price to earnings ratio. For example, right now it's December 2024, so generally you can find actual reported net income up to the third quarter of 2024, which is September 2024. You might add the last 4 quarters of net income to derive your price to earnings ratio, but oftentimes this leads to a mistake. This is because companies have a lot of one-off items in the reported net income, such as one-off taxes, one-off expenses, and etc. And therefore, you would want to look at either 2024 full-year net income projections as the basis of your price-to-earnings ratio calculation, or if you're approaching an year-end, like now, you may even want to use 2025 net income to derive your price-to-earnings ratio. Also, given all equity investors are forward-looking, in other words, they care about what will happen in the future, not the past, it makes even more sense for you to focus on forward PE ratio. Number 5, don't only rely on price to earnings ratio. Now, price to earnings ratios can be very volatile. A stock can be trading at a very high or low level because of a one-off event. For example, a political push, geopolitical tension, natural disasters like COVID-19, sudden inflow of capital from market participants, and etc. I suggest you always make your own hard, cold projections and follow your instinct when purchasing a stock. Now let's summarize the key considerations of price to earnings ratio. Number 1, price to earnings ratio is important because it shows how long of a time a company takes for it to make money up to the total value of the shares you paid to purchase it. Number 2, a company's net income forecast is what determines the price to earnings ratio. If the projections are high, a price to earnings ratio may be trading at a high level and vice versa. Number 3, you should always verify the relationship with the price to earnings ratio and net income growth of your company, which you want to invest using regression analysis and R squared analysis using comparable companies. Number 4, you should always look at forward price to earnings ratio. And number 5, don't only rely on price to earnings ratio, as it may be impacted by one-off events which may fade away quite quickly. Now that's the end of my lecture on price to earnings ratio. I'll be back with more videos soon.